As a business owner, do you wonder if you should be contributing to a registered retirement savings plan or a tax-free savings account, or should you contribute to both? Well, that is one of the common questions I've received from a number of business owners. I'm Rick Goldring of the Bay West Group, and for the most insightful information on wealth and risk management strategies for business owners, including doctors and dentists, subscribe to the Goldring Financial Leadership channel and hit the notifications bell to be notified when we upload new videos. Now here's some background with regard to tax-free savings account. They've become very popular in a very short period of time. They've only been introduced since 2009, and every year you're allowed to contribute $6,000 a year into a tax-free savings account. So if you've never contributed though in the past, in 2020 you can contribute up to $69,500 into a tax-free savings account. Now the money you deposit into a tax-free savings account is after-tax money. There is no tax incentive for you to contribute to a tax-free savings account like there is for an RRSP. However, with a tax-free savings account, the money grows completely tax-free, and when you withdraw money from a tax-free savings account, it's completely tax-free as well. So it doesn't matter whether you have stocks, bonds, mutual funds, guaranteed investment certificates, whatever you have inside a tax-free savings account, the growth is completely tax-free. And when you take out money from a tax-free savings account, that's completely tax-free. And if you do withdraw money along the way, you can take the full amount and put it back into a tax-free savings account. So if you withdraw $10,000, you can put $10,000 back in, as well as the regular contribution limit. Now with registered retirement savings plans, you can contribute 18% of your earned income to a maximum of $26,500 in the year 2020. And if you haven't contributed to the past, or you haven't contributed the maximum in the past, you do have unused contribution room, which you can make in the current year. So when you make a contribution to an RRSP, you do get a significant tax benefit. So if you contribute, say, $25,000 as an example, you can save up to $13,000 in tax when you contribute to a registered retirement savings plan. Now the money grows inside the registered retirement savings plan completely tax-free, but whenever the money is withdrawn, if you withdraw in a lump sum because you need it for an emergency, or if you wait all the way to age 71 and convert it to a registered retirement income fund, all that income is 100% taxable. So you do save tax up front, but you're certainly not avoiding tax in the future with a registered retirement savings plan. So what should you contribute to? Well, it depends on your set of circumstances. If your income in retirement is going to be less than when you're working, so you're going to pay less tax on the money you've put into the RRSP, RRSPs can make an awful lot of sense. And if your priority is to generate retirement income, RRSPs can make a lot of sense, especially if you're going to be in a lower tax bracket when you retire. If your retirement income will be fairly high, RRSPs may not be the right vehicle for you, because the expectation is that tax rates are going to increase in the future with regard to the impact of COVID-19 and aging population on healthcare and long-term care. There's a darn good chance that income tax rates will be higher for higher earning retirees than they are currently. Now, tax-free savings account may be better than an RRSP if the expectation is that your income in retirement is going to be in the same tax bracket while you're working. And plus, tax-free savings account have the benefit of the fact that you can access money without tax from the tax-free savings account in the event of an emergency like an extended pandemic. Your retirement paycheck should be made up of a number of different sources of retirement income. Fully taxable sources from RRSPs and registered retirement income funds, as well as annuities, tax-preferred portions where you use capital gains and dividends, as well as prescribed annuities, as well as tax-free portions from a tax-free savings account, as well as an insured retirement program. For business owners and professionals who have control over how they receive their income, whether it be T4 salaried income or T5 dividend income, there is merit to having a structure where you use tax-free savings accounts as well as an insured retirement program, which I talk about in other videos, that will give you the optimal level of retirement income. Now, to find out how other unique strategies can fit into your overall wealth and risk management plan, I encourage you to connect on the link below and register for my masterclass where you'll learn about lots of other strategies of how to maximize your income, your overall wealth, while minimizing risk and minimizing tax. If you like this video, please give it the thumbs up and share it with a friend. And for the most insightful information on wealth and risk management strategies for business owners, including doctors and dentists, subscribe to the Goldring Financial YouTube channel. Thanks for watching.